I mean, I really would advise anyone, and this is not investment advice, this is advice, security advice. I would advise anyone to think very, very carefully about the relationships of anyone you use to store your gold and silver. You may think you have silver, but actually all you have is, if you like, you're a creditor of whoever is offering the allocated service. You don't own anything at all. You don't even have an entitlement to any silver. You're just a creditor, and the value, if you like, of the provider's debt to you is obviously tied to the silver price. But if they go bust, you go whistle. It's as simple as that. There are then two further forms. You've got, I think, what you call pool allocated, and that's the sort of thing which gold money does. And that would be useful, and I think almost the most sensible way to go. If you have a few $1 million worth of silver, you don't want to keep it all in your home. But if you've got lots and lots of silver, then a pool allocated in an LBMA member vault, fully insured and all the rest of it, does make an awful lot of sense. But never, ever, ever go into a pool allocated arrangement with a business that is also doing an unallocated service, because the temptation to mix the two, or from your point of view as someone depositing silver, or having a relationship with a silver provider, the temptation for that provider may be to sort of take the fees and not have the silver, and or maybe rob Peter to pay Paul and all the rest of it. I mean, it's the sort of thing that banks do all the time. And it's not just banks. I mean, Germany had a hell of a problem getting gold out of the New York Fed. So you can see that this is, when it comes to precious metals, the best thing to do, I think, is really to trust no one. Now, if you're a speculator, then it really doesn't matter. I mean, all you're interested in is the price. So if you're a speculator, that's probably where things like ETFs might come in, because ETFs, again, you have absolutely no entitlement to the underlying silver. All you have is a share in a trust or a fund, as it were, and through that, on liquidation, you will have some claim over the assets of the fund. And hopefully the fund has complied with its prospectus, and if it says it's fully backed by silver, then on liquidation, probably what would happen is that the silver will be sold and money would be passed to you. That's not a claim on silver. So that's, I mean, it's one way to get exposure to the silver price, but that is about it. And here I think we must make a distinction between people who invest in silver, just the same as they invest in mines or pharmaceutical companies or whatever. It's part of a portfolio. Now, in that sense, you're measuring the performance in fiat currency. You don't actually sort of care. You're not going to be taking delivery or worrying about the security of it beyond counterparty risk, maybe. But that's it. And you're going to be taking profits. You're going to sell it eventually. Now, that's one thing. The other thing is that if you actually believe, as I do, that the global fiat currency system is in acute danger of failure, then the silver that you own, you will look to spend eventually. You won't sell it, because if you think the fiat currencies are going to go, why would you sell it for fiat currencies? So if you're going to spend it, have you got it? That's a simple question. One way in which people commonly do this is they have safe deposit boxes. Now, I don't know what the rules are in Australia, but a bank in the UK, if called upon by the authorities, has to let the authorities access your safe deposit boxes. And so you don't actually have control in the worst case, in a worst case situation, over your own assets, even though you think that they are safe in a safe deposit box to which you have a key. So there are all these considerations. I mean, I really would advise anyone, and this is not investment advice, this is advice, security advice. I would advise anyone to think very, very carefully about the relationships of anyone you use to store your gold and silver. And, I've been following this debate, which John Adams has been very much taking the run with. What has come out of this, to my mind, is that there are quite a few operations, and it's alleged, who seem to confuse unallocated with pool allocated. And this is, as I say, for an investor, it probably matters slightly less. I mean, it's completely wrong. Let me put it that way. But, for those of us who are looking at the overall economic situation and trying to protect ourselves through a potential collapse of fiat currencies, it is vital that you know what the status of your silver is, and obviously other precious metals as well. When you get a collapse of fiat currencies, which isn't, I mean, whether it's a slow event or a fast event, doesn't really matter. What happens is that people will look for substitutes for money. Now, obviously, gold is up there because central banks have gold, and the only way they can stop their monies collapsing into absolutely nothing is to reintroduce a gold standard so that, the money out there is already distributed, but let's say in Australian dollars, it's $500,000 an ounce or something like that. I mean, I'm just sort of making up a scenario. Then under those circumstances, you will have gold substitutes which people will can then rely on. The losses getting there are absolutely huge for everybody. Now, in that scenario, the only way in which you can really make a new gold substitute standard work is to back it up with coins. Now, that's the important thing. So that, I mean, we've already got sovereigns over here, which are legal tender. What I would envisage is that any country really trying to stabilize the currency situation would not just look at gold and gold coins, but also look at other forms of metallic money. And obviously leading the field is silver. You don't need to price silver at 15 to 1. You could easily price it, say, at something like 20 to 1. So if we see gold going up, I would expect to see the price of silver rising nearly twice as fast. And for anyone who thinks that gold is very undervalued in the monetary sense, then silver becomes the preferred metal to play that catch-up. Because if you look at both gold and silver, they are underpriced. They are underpriced because they're dominated by huge, great paper markets, which absorb all the potential demand, other than demand for people who really do insist on having physical.